if silver goes to 700, if it goes to 1,000 and gold goes to 30,000, would Miles Franklin be able to, buy back metals?
I think what we saw during this last deal did a lot of damage to the industry, because not only did it was the perfect storm. The charts that I read showed that silver could go as high as $200 and it wouldn't affect the cost of making these, and it's just a few cents per panel, even at $200. And so the theory that, well, silver can't go to $150, $200 or whatever that number is, it would destroy the markets. It's not true. Silver is very inelastic. It's a little bit in a big product.
The global silver market is reaching a critical inflection point where industrial demand and physical scarcity are overwhelming paper contract suppression. Rising solar panel manufacturing continues to pull vast quantities of physical bullion out of vaults regardless of spot pricing. Andy Schectman, a renowned precious metals expert and president of Miles Franklin, emphasizes that silver is extraordinarily inelastic and primed for a historic price explosion. Technical charts reveal that silver could rapidly surge to $150 or $200 per ounce without disrupting solar production costs. Furthermore, long-term technical forecasts indicate silver reaching $300 to $500 per ounce as physical delivery demand corners paper exchanges. Even conservative estimates project silver hitting $100 by year-end, while inflation-adjusted metrics from 45 years ago dictate true valuation should already sit well above $175 per ounce. If silver reaches these peak targets, gold could easily trade at 5 times its current valuation. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
There wasn't really a price floor put in. It was more along the lines of floors for the solar industry. But the charts that I read showed that silver could go as high as $200 and it wouldn't affect the cost of making these. And it's just a few cents per panel, even at $200. And so the theory that, well, silver can't go to $150, $200 or whatever that number is, it would destroy the markets. It's not true. Silver is very inelastic. It's a little bit in a big product. And I think it's a step in the direction. I mean, to me, what it really does is it just signals that really what I took away from it is that he came out by saying we need to be a minerals powerhouse, is that we've made a huge mistake by outsourcing everything for all of these years. And silver is a critical mineral. He is putting protection under the solar panel industry. There is no definitive price floor for silver, but my guess is that
we certainly know there's no ceiling either.
Yeah,
that's for sure.
I mean, my guess is that it really won't matter, as it's just becoming harder and harder to source at the institutional level. And I think there'll become a race to do so, especially as we see maybe real price discovery, as we start to see pricing slowly start to get priced in other parts of the world, in other currencies even. That will start to maybe change the entire wisdom of being naked short. I don't think silver is yet traded in Hong Kong. Maybe it is. I could be wrong, but I know gold is. And if you have the ability, which there is, to do an exchange for physical to Hong Kong, Brinks, which is a COMEX, you can deliver it there. You'd be out of your mind to be a bank who would short it in the West when there's real price discovery in yuan, same day settlement. That can do exchange for physical. This is how real price discovery will slowly move away from suppression of futures market to same day delivery, and maybe we'll begin to see what that real price is and really why the big money has been trying to stand for delivery and corner it for a while now. I think silver has a long way to run. I really do believe that, and it looks like we're right at breaking through. It came up above the cup and handle, came down and tested it, and this is a breakout.
Yeah, no doubt.
So this technically, it's a big deal, and to see it up right now, in the aftermarket,
we're trading up
dollars and something up.
60. I mean, look, right now the futures are up again. We're sitting at a 66.25. We still have the spot market higher than the futures market. So we're still in that backwardation. Michael Oliver had said 300 to 500 by summer, or by the end of summer, I should say. He also got a lot of flack where he kind of went into hiding for a little bit because he was getting berated online. And I don't think that he deserved it. I think that, opinions are like everything else. You know what? Some are bigger than others. And I think Michael Oliver has been, more right than he has been wrong. And as Andy always says, timing is a very, very difficult thing to do. But I think all of the reasons and rationale why Michael Oliver believed that 3 to 500 would be attainable is still very attainable.
Picking out of the time frame is a toughie, but
yeah,
he's an honorable guy and he believes it.
And look, I believe it too. It's just a timing.
Yeah, it's lucky to see it here this year, but who knows? I mean, it's not what we would probably expect to see, but I'd be very happy to see it. Certainly. Maybe I would. I don't know.
Mixed emotions. Happy to see it?
I mean,
I don't know.
That would be
look, that's put it this way. I think, and I love it as much as everybody, but I believe that if we saw 500 by the year end, which means that we'll probably see 5 times the gold price, then the world is in way worse shape.
But I will say that, is it really outrageous to think of silver being $100 by the end of the year? No.
Silver at $100 to me, and again, just going back 45 years, 46 years, gold was at 50. So inflation adjusted, we should already be at 175 right, just with inflation, just that alone. So yeah, I think that's why when you look at all the things that Michael Oliver puts into place, I think that's one of the things that he does take into account is putting all of those things into the numbers. It should be where, we should be north of 120. We should be north of 190 based on those numbers. But again, nobody wants to think about that. They just want to think about, and again, I keep going back to it. Nobody complains when Micron goes from $60 a share up to 900, then over 1,000. Then that's fine. But silver, we bark out going from 80 to 120 in 4 months. I just think it's kind of absurd. Intel doubled in the first 3 months of the year, whatever it was. So that's my take on it.
Central banks are caught in an escalating systemic trap as unannounced yield curve control mechanisms distort global bond markets. Recent international interventions surrounding the Japanese yen demonstrate how monetary authorities manipulate foreign exchange rates to artificially protect treasury markets from organic price discovery. Years of zero-interest borrowing drove institutions into massive carry trades, funneling cheap capital into high-yield paper assets and mega-tech equities. However, attempting to tightly control currency fluctuations creates severe friction, as allowing yields or exchange rates to drift too far risks unwinding massive leverage. When sovereign nations face restrictions on liquidating foreign debt holdings during emergencies, institutional trust in paper liabilities deteriorates rapidly. Consequently, large capital allocators are incentivized to abandon sovereign treasuries in favor of holding unencumbered physical precious metals directly in vault storage, shifting settlement power away from paper futures markets toward immediate physical delivery. Now, let's get back to the interview.
The question becomes, does higher interest really attract money into the treasury market on long-term maturity, and will it even be allowed to? You could argue that what we saw with the intervention into the yen was a form of yield curve control. They did it less to support the yen and more to support the bond market, where if Japan had done what it was supposed to do, and that would be to sell its largest asset to come up with enough money to buy the yen to support it.
But that would be the treasury.
That's price discovery. Right. That's right.
Yeah.
And instead we intervene again and manipulate again. And it's becoming transparent to the world that, that will tell you when you can sell your treasuries if you have a lot of them and under what terms is kind of the way the market is reading it. And this is just incentivizing more selling of treasuries and buying of gold to hold in your own possession, because, if the largest holder of treasuries can't sell them when they need to sell them,
it's a problem.
That's a problem.
So, what do you think in terms of the layman, the everyday Joe? How many people do you think actually know what the carry trade is all about?
Not many.
Like we're talking under 15%.
Probably.
I would think that's probably about like a good number, maybe 20%.
Probably.
There's not that many, I think, that do.
Well, and also by supporting the yen, it's like they don't want the yen to go too high, because if the yen goes too high, all of the traders who are already in the trade, who see the yen carry trade is, you for years the interest rates in Japan were zero or negative. You borrow in yen at zero or even under zero,
Right.
convert to dollars, and usually dollars and other currencies too, but you buy assets.
And this part, it was the treasury is paying a higher yield.
Or even high
Right.
tech,
Yeah.
that
Yeah.
buy all of the, the Nvidia and the Apple and whatnot.
Yep.
By the U.S. supporting the yen, they want it to go up just high enough, but not too high, because if it goes up too high, all of those traders who are already inside of the carry trade will have to convert back to a yen that's gone way up, and it will incentivize them to come back and bring the money back home, and that would be unwinding things like Nvidia, or treasuries. It would create pressure on the markets, but yet if it goes too low and rates have to go higher, so they're trapped. They're trapped between it's a fine line between letting the yen go up too high and letting rates go up too high.
It's like a science to make sure that it doesn't go heavily to one way to the other.
Yeah, when you get that deep into the mix, it's a problem.
Yeah, well, too far down the rabbit hole, it can be good.
Well, and it starts to become a situation where the market just expects this to be a backstop. Is this a never-ending backstop? Price discovery is created not through lending but through buying and selling.
Yeah, well, and I think this was all. I think we really started to see the market movement in metals after the job report. I think that's really what kind of precipitated the move. The U.S. labor market appeared much weaker than the initial monthly headlines, which, of course, we always hear about the CPI and all the numbers, and then guess what? 1 week later, 2 weeks later, a month later, we do the revisions, and the revisions are not just a couple of numbers.
This was a big one.
Revisions, right?
It was like negative 18,000.
Yeah.
Versus adding 180.
July lost 23,000 jobs versus expectations for 83,000 new jobs. It's a big number. It's a pretty big divergence between,
$100,000 job difference.
Yes, that's a pretty big number. And when they say unemployment fell to 4.1%, but that's just because fewer people were participating in the labor force.
You're seeing layoffs and greater efficiency. Is this AI already coming in? Because you look at the stock market roaring all-time highs. So is there a growing divergence between Main Street and Wall Street? This is the whole idea of the Cantillon effect, where the rich get richer as they own assets. Though that's Wall Street, the banks, and people who can afford assets. Prices keep going up in their assets, but the cost of living is going higher and higher. And at the same time, you have issues with unemployment. You see guys like what's his name, Ken Griffith from Citadel saying, I'm watching AI do faster and more efficiently right now than the analysts I'm paying seven figures to. So, no one's immune from this AI revolution, and it distorts. So you have all this efficiency and cost savings, and Wall Street's roaring, but Main Street doesn't appear to be.
The thing about Wall Street roaring is, and especially that's why I think that this, in particular, this July report was bad, not just because of the jobs decline. It's that the previous numbers were so significantly overstated that what happened when they weren't? The market roared. And now they do a revision, market comes back, then they'll come out with another BS number, market will roar again, they'll do another revision. At what point? At what point does it become almost just, it's
already
mundane to me and comical.
The stupidity of it is that the markets react the way they do to
right.
it. And if you go back, I bet you look at every single labor report going back to the Biden administration and beyond, they're all revised in a negative manner.
100%.
But the markets react to the instant news. That's why I've always just preferred to not try and time anything, look at the big macro picture. And the macro picture is we live in an environment where they can't afford to not continue to pump money into the system, but at the same time, they can't afford to let rates rise, and you're going to see yield curve control. So, to me, what you saw was a form of yield curve control without it being yield curve control. Not calling it that, and the way that manifests, would be through the release valve is interest rates going higher. If you cap rates, then the release valve is in through inflation. And a lot of you talk about the BLS, which should be the BS, talking about the CPI. Most of that inflation, they're trying to talk inflation down. They're trying to find different ways, again, of measuring inflation. Even when they've gone over 60 straight months of not getting it to 2%, they want to find ways to, strip out the outliers and make it closer to 2%. That's all nonsense, because much of the money, by the way, that's gone into the economy has gone into assets, and that's stuff not evidently counted by the Bureau of Labor Statistics. When that money starts to come out into the real economy, you'll see massive inflation. And let's not forget that price inflation through the supply side, price inflation through rising oil costs usually takes about 6 months to work its way into higher prices.
Yeah.
And we haven't begun to see that yet. So yeah, things are going to get nuts with rates and the Fed and intervention, and buckle up.
A profound structural divergence continues to widen between buoyant Wall Street asset valuations and the weakening foundation of the real economy. Official government labor statistics frequently broadcast optimistic employment headlines to boost sentiment, only to quietly execute massive negative revisions weeks later that reveal underlying job contraction. While stock market indexes reach record levels driven by aggressive corporate cost-cutting, automation, and artificial intelligence adoption, everyday citizens face escalating living expenses and shrinking employment opportunities. This economic split vividly illustrates the Cantillon effect, where financial institutions and wealthy asset owners absorb newly created liquidity first, driving up paper asset prices while leaving Main Street with persistent purchasing power erosion. Monetary authorities continuously attempt to understate real inflation by modifying consumer price index calculations and stripping out volatile economic outliers. However, vast amounts of liquidity previously trapped within paper asset bubbles will eventually spill over into the tangible economy, igniting severe price pressure across essential consumer goods. Furthermore, supply-side inflation stemming from elevated energy prices and manufacturing constraints typically takes 6 months to fully pass through to retail markets, ensuring that future consumer cost pressures will intensify significantly regardless of official policy claims. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.